We welcome in our next guest, Dean Smith, Chief Strategist, Folio Beyond, to talk about the market action and how you prepare, too, for some of the volatility. Today, we've had the Trump administration announcing a deal that brought some optimism because they talk about the comprehensive agreement with the UK, and that started the market off in the green early in the morning. Does this mean more deals could be coming? What does it mean to you?
Well, I did watch the press conference from the Oval Office earlier today. If this was a tech announcement, we would call it vaporware. It was pretty short on specifics. They didn't really have a whole lot to say about how specifically this was going to work. Putting these deals together takes a long time. There's a lot of details, and we don't think that this announcement changes anything very much. China is certainly going to negotiate very, very hard for what they believe is in their interest. So this one little announcement does not mean that the tariff war is over. It's just barely started.
Understood. So the Trump administration has certainly come on with a lot of things all at the same time and brought on a lot of market volatility as well as a huge sell-off. What say you about that kind of action? Obviously, no one wants that kind of action, but now what? As we claw back, volatility is taking a bit of a breather. What do you think?
Well, I don't know. I mean, we're down almost 3/4 of a point on the 10-year just today alone. With in the last couple of weeks, we've retraced about half of the rally that we saw. Interest rates, especially at the long end, 10 years and out, still remain well above, the levels that we saw in the past several years. And this is really the new normal that I think we have to get used to. Interest rates are going to continue to remain elevated. We think they're likely to go higher from here rather than lower over the next several years. And there's going to continue to be a lot of volatility in the markets related not only to the tariffs, but to a lot of other things that are going on. So we think it makes sense for most investors to continue to be very cautious and to reduce, in particular, their exposure to interest rate volatility, reduce their duration.
So big picture here, you're thinking about ways to manage risk overall here on Wall Street. You wrote in your notes. Tell me how you advise folks to do that.
Well, we launched about 3.5 years ago an ETF specifically to help people do this. It's the ticker is RISR, and it's an interest rate hedge product that really fills a need that didn't exist in the market before we launched this. So it buys a particular type of mortgage-backed security that zigs when the rest of the fixed income market zags. And so we think that including some kind of hedge like that is prudent for almost all investors. This product has what's called negative duration. It goes up in value as interest rates increase. It also has extremely low, almost no correlation to equities. So a product like that, which can produce an offset to other risks in the portfolio while also producing a pretty attractive dividend. It's almost a 6% dividend yield on this. We think is something that can be a part of an overall risk management strategy that we think makes sense for a lot of people.
And you said since inception, our return has been almost 18% on an annualized basis. I mean, that's certainly
right.
An outperformer, and with recognition, a 5-star Morningstar rating, that's good news overall. So RISR, something folks can take a look at. I mean, a final thought on that, because it's broadly available to everybody, right?
Yeah, I mean, it's an ETF. It trades like any other ETF. You can get it from Schwab. You can get it from anybody. And we think that it has a good fit for whether you're a fixed income investor, you've got a blended portfolio. But the key that I want people to take away is that we are not nearly out of the woods here. And it's going to be a bumpy ride for a while. If we get stagflation, as we're thinking is highly possible, continued high and volatile interest rates, a slowing of the economy, a slowing of employment, that slows down housing turnover. That's also good for this strategy.
Right. I mean, I was thinking about the stagflation story. How likely do you think it is, if you gave it a percentage, that we will be in a stagflation environment for our economy?
Well, I mean, if you listen to the Fed, and Jay Powell spoke yesterday, they're on the sidelines. They are completely out of the game at this point. He said several times, we're just going to wait. We're not going to do anything. They're not going to move preemptively. He said that several times as well. So they're going to wait until they see problems really arise before they make their next move. So anybody who still thinks that there's going to be 4 rate cuts this year or 3 rate cuts this year, we think that's frankly delusional. The Fed is off the field, and they're going to wait and see how bad things get before they make a move. Now, the other problem that they have is, since the Fed only really has the control over short-term interest rates, if we have a recessionary environment with continued price increases, that's kind of a problem for them. They can't use just cutting the Fed funds rate to solve both of those problems simultaneously. So they're in a tough spot. The economy is in a tough spot, and I don't know what's a probability that you should be concerned about. I think there's at least a 35% chance of a stagflationary period, maybe as high as 50%.
All right, good to see you. Thank you so much, Dean Smith, Folio Beyond. Thank you.